Well, hello, beautiful people. This is Jessica Jones with Taurus Financial Solutions, coming to you today with a quick video on Roth conversions. So Roth IRA conversions. I've been getting a lot of questions about this, and should I do it? What is it? How do I do it? Why would I do it? All these things. Okay, so a Roth IRA is an IRA that grows tax deferred, and then you pull it out also tax free. So it's after tax money. So a traditional IRA, you are putting it in now and you are getting a tax write-off today for putting that money in, and it grows tax deferred. But then once you start pulling it out in a traditional IRA, you're going to pay taxes on the entire amount because you've never paid taxes on that. That's a traditional IRA. That has your required minimum distributions. It's now at age 72 that you have to start pulling out your IRA monies because Uncle Sam wants his taxes, right? You haven't paid taxes on that money all this time. The difference between that and a Roth IRA is that Roth IRAs are funded with after-tax money. So you've already paid taxes on that money, and you don't get a tax write-off now because the trade-off is you don't have to pay taxes on any of the earnings when you start pulling it out. And there's no requirements to pull it out, but you don't pay taxes on it anyway when you start pulling it out. So a Roth is a fantastic planning tool. I am very pro Roth because I can't imagine taxes going down in the future. I'm not a CPA. This is not tax advice, but this is my personal opinion, and this is what I walk clients through as well. It's important to have a combination of before tax money and after tax money. But in my opinion, if I can just get the taxes paid now and get it over with, I would rather do that, right? So there's a couple stipulations to a Roth. In order to be able to start one, there's income limits, okay? So there's a phase out limit for individuals that start phasing out at $125,000 a year. And for married filing joint, it starts phasing out at $198 per year income. So then you cannot contribute to it anymore, which sucks in my opinion. I don't think there should be an income max, but that's the way it is. And also there's limits to what you can put in annually if you do meet those income limits, okay? So you can't put all that you want into there. So that's how you start a Roth. But let's say you already have started an IRA and or you're past the income limits to keep contributing to your Roth. You can do what's called a Roth conversion, which means that you're taking your IRA monies and you are paying the taxes on them and converting them to a Roth IRA, so that ideally your money will keep growing and growing and growing, and then you will not have to pay taxes on all of that money when you pull it out because you would have paid taxes on it when you do the conversion. So there's a couple things to remember with this. You're gonna have to pay the taxes right now when you do the conversion in that year, okay? So you need to be strategic also about how much you're converting, because you don't want to bump yourself into another tax bracket by converting that, because by converting it, you're taking it out and you're paying taxes on whatever the amount is. So a lot of times it's good to do it in increments, you know, whatever, depending on your tax bracket, maybe $10,000 a year or $20,000 a year. It just really depends on where you are tax-wise. You need to also have the money to pay the taxes on that amount, right? But then you convert it over, it's in a Roth now, and it will continue to grow and grow and grow. It needs to stay there in at least 5 years before you start pulling it out in order for it to maintain that proper tax status. So just remember that as well. But it's a really good way to get around the income limits and get, you know, and pay the taxes now with the thought that taxes are probably going to be higher in the future, and or your income may continue to be higher. The whole point of the IRAs was that ideally your income would be lower in retirement when you start pulling it out, so that you would be at a lower tax bracket at that time. But a lot of my clients are finding that's not necessarily true. They may have done very well for themselves, and or now they have rental incomes, or inheritances, or sell properties or things like that, so their income is still pretty high in retirement. If you have questions on this, please ask me. I know this is kind of a real quick overview on it, but it's a really neat planning tool, and it may be a good thing for you to look at. So please call me, email me. It's taurusfinancialsolutions.net. Again, thank you so much for listening, and have a wonderful day. Bye.